In this video, I'm going to be simplifying the ICT 2022 mentorship. If you did not watch episode 1, I covered all of this on the screen in episode 1. Make sure you check that out. I'll leave it in the description down below. In this episode, we'll be talking about order blocks, institutional order flow, and incorporating the economic calendar into the 2022 model. And this is what the 2022 model looks like. If I were to give a simple representation, it is a liquidity grab, then a market structure shift with a fair value gap. So in the bullish example, it takes out an old low, creates a market structure shift to the upside, and it creates a fair value gap in that market structure shift. In the bearish example, takes out buy side liquidity, creates a bearish market structure shift lower, taking out an old low, and then creates a bearish fair value gap. We covered all this again in episode 1. So let's dive straight into order blocks and what defines a high probability order block. So a high probability order block is an order block that takes out liquidity, has a fair value gap, and creates a market structure shift. So if we look over here, you could see that an old high was taken out. When an old high gets taken out and price reverses, right, we look at this as a potential run on buy side liquidity. What we want to see next is a market structure shift. So we want to see an old low get taken out. You can see that gets taken out right here. What does it also need to have? It also needs to have a fair value gap. We have that fair value gap right here. So in the bearish example, you're looking for a bearish fair value gap. You're looking for buy side liquidity to be ran and also a market structure shift. When this happens and price closes beneath these consecutive up close candles, that validates this move upwards becoming a order block. Now, all of these consecutive up close candles are one order block. This entire price leg from this low to this high is an order block. The sweet spot of the order block is going to be this high. That is why you will typically see ICT, if price retraces high up, he'll just mark out the high of the order block because this is the sweet spot of it. But all of these 4 up close candles are one order block. That's important to recognize. Now, since price just kind of retraces up, what he would normally do here, if price starts to reject this, is ICT would mark out the opening price of this consecutive up close candle move to the upside. As you can see, price returns into it here, tests that as resistance, then starts to head lower. This is a high probability order block because it took out liquidity, it had a bearish fair value gap, and it created a market structure shift, and this was all in a bearish environment. Now let's move on to a bullish example. Same exact thing. High probability order block, takes out liquidity, has a fair value gap, and creates a market structure shift. Here it takes out a daily sell side liquidity. It also created a market structure shift, which we do have right here, takes out that old high. What else does it need? It needs a fair value gap. So it has a fair value gap right in here, a very small one, but it creates it nonetheless. So these 2 down close candles become a bullish order block. When price returns to that, if you're bullish, you want to see that potentially act as support before continuing higher. So these consecutive 2 down close candles are one order block. The last down close candle is the sweet spot of the order block. Before we do continue, if you guys want to see more of these concepts, make sure to follow me on Twitter at DanDowTrading, and you could also check out a 3-day free trial link to my Discord. I did have an 84% win rate using ICT concepts intraday in my Discord. That'll be first link down below. So now let's dive into what institutional order flow is. Now, when you already have a bias and you know where price is heading, for this example, let's say that we knew that price was going to draw up into this high up here. As price is delivering to a buy side target, institutional order flow will be bullish, meaning down close candles will act as support. So price breaks up, comes back down, taps into these consecutive down close candles. Remember, this is one order block. The last down close candle is the sweet spot. So I'm going to mark out the open of the last down close candle, and here price starts to rip higher. You can see that it continues higher. What happens? It respects down close candles. So it breaks up, retest this down close candle, right? We're in a buy program. As price is heading higher, down close candles are going to act as support. So in this example, when you do have super long upper wicks, you could draw a line on the open and also on the upper wick. It's important to note that the entire down close candle is the order block here. You can see we had a nice little fair value gap in there. Price retests it, continues higher. This last down close candle creates a fair value gap, rips higher. I'm just marking out the upper wick on this one because that's all it respects before continuing higher. In a bearish example, when we're anticipating price to trade lower, let's say we have a 2022 model already in play, suggesting that price is going to start targeting this low down here, we're anticipating for up close candles to act as resistance. So we're just reversing it. You can see price returns up, taps into an up close candle, retested as resistance, drops lower, comes back up, retests this up close candle as resistance, then drops lower. We get a sharp drop down. So someone might look at this and say, well, this up close candle doesn't act as resistance before heading lower. It rips up higher. Why does it tap into these ones? Well, looking at this from a smart money perspective, we have these old highs clustered close together, which is buy side liquidity. So smart money takes out all the liquidity, taps it into the order block. Now they reverse it because they have more liquidity. So it's just kind of engineering buy side. Smart money takes it out, then reverses it lower. In short, when we have a bullish draw in liquidity, down close candles will act as support. And also when we have a bearish draw in liquidity, up close candles will act as resistance until that level is traded to. It doesn't mean every single one has to, but typically it will. When you have engineered liquidity above like this, it's best to just be nimble and not really expect every single one to act as resistance. Wait for it to get taken out before price trades lower. Now we'll be taking a look at the economic calendar and how to utilize that. ICT talks about 8:30 is the news embargo lifts, meaning that's when news starts to hit the market, and news can be used as a smoke screen. It's used as manipulation. They're either going to use it to take out liquidity, or they're going to use it as volatility to deliver to a target, whether it be delivering to an imbalance or a level of buy side or sell side liquidity. It's important not to trade before high impact news events because there's a lot of volatility, especially if you're a new trader. Sometimes the fluctuation to the market is just extreme and you don't want to get caught in slippage. If you want to look for high impact news events, you could use forexfactory.com. This is what I use. And I just kind of look between the hours of 9:30 a.m. to 4 p.m. and see if there's red folder news. And if there is, it's important, especially for the newer trader, to wait till after. So here's a little ICT gem for you guys. When there is high impact news at 10 a.m., it extends the New York kill zone into 11 to 11:30. Because the volatility it will bring in. Here's another example. ICT does not care about the data. What he is expecting is volatility. The algorithm is going to use that injection of volatility to facilitate trades. Now it is trying to give you good trades. No, it's trying to move and rebook and reprice levels to allow those in the know, he's talking about smart money, to participate. It's a rigged game. You're not supposed to be in it. Smart money is utilizing news for their benefit. They're using it to either manipulate your stops or deliver it to a level of liquidity where they could exit their position. So if you are new, it's best to wait till after high impact news and then start looking for setups. If you guys enjoyed this video, make sure you smash that like button and I'll continue this series. This is episode 2. Let's get this to 100 likes and I will do an episode 3.